Well, morning Lynn, and welcome everyone to our economic update.
I can't believe it's October now. Christmas is just around the corner. I cannot wait for the Halloween to finish so I can put out my Christmas decoration. I guess today we're going to talk about what's going on in Australia, some key economic data, and then we'll move on to the U.S. And I guess moving to the next part, we'll have a quick overview of how the market has been performing this calendar year so far, and we'll wrap up by tying it back to what it means to long-term investors and our clients.
Yeah, fair to say there's been a little bit going on the last few weeks.
Yes, as always. I feel like we say this every month, but definitely a whole new run of data. I guess let's get into the Australian part first. Biggest news in recent time?
Yeah, certainly from an RBA perspective, not unexpectedly, the RBA met in September and rates were left unchanged. So the three cuts that transpired earlier in the year have been paused. And I think that's probably a reflection of just a more cautious approach. And do you want to extend on that notion, Ben?
Yeah, you're definitely right. I agree. Like, it's really no surprise there. That's probably what the market has been expecting. And what is more interesting usually is not just about the decision itself, it's the post-meeting communication. Straight away, they highlight the just this upside surprising CPI data, and they acknowledge that the economy is still looking very strong. We'll touch on the GDP data, is still more on the higher side, is higher than expected. Overall, it's very apparent that RBA is very data dependent at this stage. They're not really trying to follow a strict date schedule. So yeah, definitely we are seeing that they are implementing a really cautious, gradual approach to reduce the rate cut.
Yeah, certainly there's a divergence too across the banks around their forecasts. I mean, forecasts are a bit like opinions. Everyone's got one. Doesn't mean it's right. But I think looking the last couple of days, NAB have revised their forecasts. So they're forecasting, their forecast reflects the next cut middle of next year, I think. So that's their perspective, and a couple of other banks are still leaning towards another cut this calendar year and one or two more. So yeah, it's just the nature of the beast. No one's going to get things right, or not everyone's going to get it right. But yeah, it's interesting how different banks and institutions see things a bit differently.
And also, it's probably a good point to reflect on the forecast and expectation leading up to this point. There's lots of discussion from late last year, broadly, that they were expecting some rate cuts this calendar year, and how the reality has played out is pretty much in line with what was expected from late last year, because we were expecting a few rate cuts this year. If anything, the timing of the rate cut came out to be even more aggressive than expected. I think later last year they weren't expecting any rate cut until later of this year. But as we can see, RBA started to cut rate from as early as February and another one in May. So at that front, definitely, broadly, how this calendar year has played out has been in line with the last year's expectation. But then, as you mentioned, as time goes on, the expectation and the forecast continue to change. Now, all the major banks that expecting no rate cut until at least early next year, if not later.
Yeah, and it's for those that can see the chart, the dashed line is a CPI, the monthly CPI indicator, just as a reminder, and it has increased. So that's given the RBA some cause for concern, and was probably prompted the latest whole decision, or one of the key data points.
Some other interesting data were released last month as well. Another big one is the GDP data.
Yeah, it surprised a little bit on the upside, not massively, but the market consensus was 0.5%. It came in at 0.6 for a full year, 1.8% number. So still well below long-term trends.
Yeah.
There's some varying reasons for that. You know, just perhaps on some of those main causes of below long-term trends.
Yeah, exactly, because it's very important to put this into perspective and understand how to interpret this data, right? As we have seen, the last year annual GDP growth is 1.8, and as you mentioned, since 1960, the average GDP annual data in Australia is actually about 3.3. So if we just compare it with the long-term average, we're definitely quite below that. But it's not without good reason, because this long-term historic GDP annual data in Australia was mainly driven by population growth, immigration, and the productivity. And also, of course, as you would know, the current slowdown in economy is done deliberately, is intentional. That's the whole purpose for the 2023-2024 that like rate cuts and the RBA's policies, they try to slow the economy down and have inflation under control. So overall, nothing is alarming from the GDP data. It's very intentional. I guess that's what the market has been expecting. It seems like we have reached that soft landing scenario now.
Would appear so, yeah. Mm-hmm. And I think the next quarter results will determine whether that 0.6 was a little bit of a spike, or whether that trend will continue. Because if you look at for those that again can see the chart, those quarterly GDP growth rates over last quarters have been 0.3, 0.6, 0.3, and 0.6. So they've bounced around a little bit. I heard a comment a couple of weeks ago that suggested maybe the British Lions that were out here do it for the rugby and the influx of tourists that had might have been a contributor to that 0.6, but time will tell. So yeah, I think the next quarterly result will determine whether things are back on track again.
Yeah, that's right. Maybe just a quick note on the labour market, the unemployment rate that stood at 4.2 is the same as the previous month, and broadly is in line with the market expectation. And again, just to put things into perspective, in Australia, RBA, we don't really have a target rate for the unemployment rate, but what they are trying to achieve is to have it as low as possible without triggering excessive inflation. So broadly, that range is somewhere between 4% to 4.25. So I guess 4.2 is comfortably within that range. But it's also important to consider the current economy background, given we are still seeing relatively high inflation and the rate is still relatively high. It seems like RBA made it pretty clear that they do acknowledge that the labour market is steady, but it's still a little bit tight. So it sounds like they are waiting for this unemployment rate to just go up a bit higher before they can have a clear reading on the labour market. I think that's the highlights for Australia.
Yeah, I think so.
Before we move on to, I guess, the biggest news recently on the headline.
Yeah, I'm sure everyone's heard about it. It's been spoken a fair bit. The US government shutdown could invoke a lot of concern and uncertainty around us, but it's not unusual in the US. I think over the last 50 years there's been 20 of them. Not too many of recent times. Having said that, last one was when Trump was also in government 5 years ago. So yeah, he seems to have an appetite for this sort of thing based on trend. What we're seeing though, it doesn't really have a market impact. So as a headline, it's quite a strong headline, but the impacts associated with that. But basically, what it means is if the US government haven't passed the funding legislation for the next year, and their fiscal year starts on the 1st of October. So last week on the 1st, the government imposed that shutdown, impacted about 750,000 employees. So they've basically been told they've been temporarily laid off without pay. In shutdowns previously, that when the shutdown has ceased, those employees have been back paid. So the feeling is that will still continue. The timing of the shutdown is still a bit up in the air in terms of duration.
Yeah, definitely I agree with everything you just shared there. At the core, the shutdown is triggered by disagreement on the funding, government funding, how much they should spend and where they should spend it. I think you're right, this is also a good time to reflect on the history, because it's usually a very good indicator on how this usually would play out. And interestingly, the last government shutdown, which was also the longest one so far, was also under Trump's administration. And that shutdown lasted for 34 days. And on average, usually the shutdown is over within a week. So definitely the last one was a pretty dramatic one.
Yep.
But at the time, the market didn't react too badly. If anything, the market actually increased by almost 10%, if not more, during that 34 days. So as soon as the government reopen, those impacts tend to recover very quickly. That's why market usually can see through that. They focus on more on the underlying economy growth and the hard data, rather than this pure political disagreement and show. It's not the economy in crisis, it's just a political theatre scene.
Yeah, well, in fact, the impact on GDP from last time, so 34 days, it was calculated at 0.05% of GDP, so quite a smallish impact.
Yeah, I guess a quick run through of the key economic data from the U.S. and the key news other than the government shutdown would be the Fed's decision in last month.
Yeah, so last month they actually reduced the rates by 25 basis points. Yep. Their first cut for quite a while actually. It's their first cut in the current calendar year. And that wasn't a surprise. That was very much expected based on the economic data, and then like the RBA and what we're doing in Australia, very cautious approach, measured approach, data dependent. Ironically, with the government shutdown, there's not going to be a lot of data coming out while that's in force. So, but nonetheless, they're a bit like the RBA. There's things have certainly stabilised. Points there, then? Yeah,
that's right. The US data CPI is broadly consistent with forecast. Still a bit on the higher end, but is within the acceptable range already. In terms of unemployment rate, the latest data is actually the strongest for a while. The unemployment rate has been the highest since October 2021. It's showing the labor market there is not overheating and it's also not too soft. Again, it's within that ideal range. And in terms of GDP, actually, this is an interesting one from US. Their last quarter, June quarter 2025, GDP annualized number is 3.8. That is actually very, very strong given where we're at right now. But the underlying data from US is showing that their economy is still also very strong. Quite resilient. Quite resilient. This again has been what I've been saying all this time. The inflation seems to be very sticky, and Feds they always say that recently that the last mile of disinflation is the hardest part. But the key message is still the same. I think both governments they believe that they can fix a slowdown more easily than they can fix a second inflation spike. So they're just trying to be very, very cautious in interpreting the data.
Yeah, and that's a natural cause of concern, because if inflation gets out of control again, that's really going to hit hard.
All right, I think that's the main highlights for economy data, both in Australia and U.S. The most important thing is how we tie it back to making investment decision, because while they're all very amusing and entertaining to talk about, the reality is, as you would know, as I hope all our existing clients would know, we don't really make decision based on short-lived news.
Yeah, that's right. Yeah, the moment you start doing that, you you can unwind some of the good that's come out of a disciplined approach. So if you start trying to get a little bit too cute and react on every bit of bad news or poor economic news or outcomes, then that can be at your detriment.
Definitely. Andrew, you want to give a quick summary about how the market has been performing for this calendar year?
Yeah, it's been quite strong, Lynn.
Yeah.
As for those that can see the chart on the top right-hand side of the slide there, you'll see that there's been a really strong uplift, upward climb towards the end of that chart, and that's reflected in this is what the US share market, isn't it?
This is actually our high growth portfolio.
That's our high, okay,
which
so
is captured
it's our
pretty much
diversified portfolio.
Yeah,
so yeah, really strong returns. Interestingly, over the last 12 months, can't quite read that number, but it's done a bit under 15%. I think it's at 14.6%, which is the same as the 6-month number. So what happened in the first? What has happened in the first half of that period? Been to the end of September, the Trump effect again, when he made those tariff announcements. So there was a bit early in the calendar year, so around January, when he formed government again and spoke of some tariffs. There was a bit of disruption to the markets. They then subsequently recovered, but then there was another downward, a fall early April when he came out and made those reciprocal tariff announcements. But since then, it's been a really strong uplift. So the point being is, and the chart there is over a 5 or 6 year period. You can see scattered through there periods of uplift, followed by a decline, followed by periods of uplift, followed by a decline. So what we're saying there is, be consistent, stay disciplined with your approach around investing.
Yeah, exactly. That's right. Of course, everyone's situation is different, and we would have a more tailored answer to each client. But broadly, and what we often do is adopt this dollar cost averaging approach, and also just highlight the fact that we do adopt a long-term investment view, and in retrospect, and also as history proved, when you look back or look forward with a long-term lens, this short-term volatility rarely matters so much. It's not about time in the market, it's about time in the market.
Sure.
So definitely get started and being mindful of the dollar cost averaging benefits. What truly matters of the long term is actually just having diversification, discipline, and patience. Control what you can control, which would be, for example, your saving habit, the investment strategies, and also your behavior. Then just let the rest play in the background. That's our key message, and nothing have changed. It's the same theme.
Yeah, and just the usual disclaimer as well.
Yeah.
It's general information only.
Yeah.
Reach out if you want more information or specific advice. And if you've made it this far, thank you for listening.
Yeah, thank you.
And thanks, Lynn, and we'll see you next time.
Nice, see you.